Something crazy happened with Tesla, and it has nothing to do with cars. Elon Musk and Donald Trump just went to war, and not behind closed doors. They did this publicly. And here's what Elon said about Donald Trump. He said, the real Donald Trump, on a post on X, is in the Epstein files, which is why they have not been made public. We're going to talk about why this is bad, what's going on between Elon and Trump. But first, today, Friday, June 6th, 6 p.m. Eastern, 3 p.m. Pacific, my free masterclass webinar. The link is in the information box below. Very limited spots left for the webinar tonight. We're almost completely full. I will be teaching my AVP and my exclusive strategies in Discord and showing you why you're losing and how you can win, and unveiling the truth behind the stock market and what's actually going on. And there's a lot more than you think. Every student that has ever attended my webinar says they have learned more in the 1 hour with me than they have anywhere else. I look forward to seeing you there tonight. Huge announcement. I'll be taking your questions. I'll see you at the webinar tonight at 6 o'clock. Elon is bad at relationships, and this hurts Tesla. Tesla may lose political protection. Elon Musk used to have insider access to both Biden and now Trump, and this situation is not good because Musk has just burned a major bridge. Losing federal favor could hurt Tesla's chances at government contracts, tax breaks, regulatory leniency, especially around autonomous driving. EV tax credits could vanish. The bill that Elon attacked aims to slash EV incentives. If it passes, Teslas become more expensive for American buyers. That could slow U.S. demand just when competition from China and legacy automakers is heating up. If you own Tesla now, you should really think about hedging with options. And I'm going to tell you guys exactly what I would do in this video and how to hedge on Tesla, because things are really starting to heat up. And it seems that all of the protesting that went against Elon several months ago when he backed Donald Trump for the election seems somewhat warranted now to some degree. And I say this because you can't go around slinging mud childishly like he's doing. Not that I'm taking any sides, but this whole situation is not good when you're running a business. He doesn't know how to keep his personal and his business separate. He says things that are kind of questionable, and this is hurting Tesla. Institutional investors hate uncertainty. Big money doesn't like drama, especially when it comes from a CEO. Musk's emotional outbursts have caused sell-offs before. This one could stick longer because it's political and financial at the same time. Media attention equals brand damage, especially when it's coming in this form. Musk picking a public fight with the current president shifts the narrative from innovation to instability. Tesla's brand, once seen as a future forward, risks becoming polarizing, especially to conservative-leaning consumers or lawmakers. This is not good for Tesla. It is very damaging. So, should you buy Tesla? Should you invest? How should you approach this situation? If you currently own Tesla, what should you do? What are your options to become profitable? Volatility is a very good thing for option traders, but it can be damaging and it can be risky to beginners. So you have to understand exactly how to tackle this hurdle and to convert volatility into profit. And I want to show you exactly how I personally would handle Tesla and what I'm doing and what you should likely do if you want to be safer, hedge, and make money on Tesla, especially long term, because long term it's still a very positive stock, but right now it's kind of up in the air with everything that's going on. If you want to learn the strategies that I'm about to show you in this video on how to hedge, and you want to learn even more of them, and you want to understand the market more, I look forward to seeing you at the webinar tonight, Friday, June 6th, today, 6 p.m. Eastern, 3 p.m. Pacific. Link to register is in the information box below. I have a huge announcement, and I'll be answering your questions at the webinar. So we're going to dive into the charts. I'm going to show you what I would do, look at analytics, and show you guys how I would hedge if I currently own Tesla, how I would look to enter Tesla if I didn't own it, and how to play it safe but still generate premium off of the volatility on Tesla. Before we get into the charts, I just want to read this for you. A war of words between Elon Musk and President Donald Trump erupted in into full meltdown Thursday. Musk slamming Trump for ingratitude over the 2024 election, agreeing with a call for his impeachment, knocking the president's signature legislation, and even claiming Trump was in the Epstein files. Trump, speaking on television from the Oval Office, had said he was disappointed in Musk following his criticism Tuesday of his big, beautiful mega bill to fund his agenda, and then engaged in mutual barrage of social media posts, at one point saying Musk had gone crazy. As the exchanges grew progressively personal, Musk posted without providing evidence about Trump and Jeffrey Epstein, accused of sex trafficking of minors in 2019. Time to drop the real big bomb. At the real Donald Trump is in the Epstein files. That is the real reason they have not been made public. Have a nice day, Donald J. Trump. He followed that up with other posts saying, mark this post for the future, the truth will come out. Trump has previously posted, I was never on Epstein's plane or at his stupid island, and he has not publicly objected to the release of the new files now under the Justice Department review. If Elon Musk is lying about this, I'm not saying it's true, not saying it's false, not saying any of that. I'm saying if it is a lie, or if the truth comes out and Trump was not there, or there is a reason that he was there, but whatever the case may be, if it goes against what Elon's trying to paint a picture of, that, it's a very bad thing. If anything goes against what Elon's saying right now and it comes out that Elon was just slandering Trump with a barrage of attacks, this is going to be very bad for Tesla, and the truth may not come out for months or years, but when that does come out, it could be a pretty negative hammer on Tesla. It could. It's hard to say if it will not, but it could. Just be aware of that. If you're looking to hedge your position on Tesla, and let's say you have an average price of, just an example, $325, then what you should be looking to do right now is selling covered calls around $340, 3 or 4 weeks out. And then what you'll end up doing is buying put options right around the current price or slightly above. You want to be able to utilize put options to protect you on the downside. So what you're looking to do is sell covered calls that will in turn finance your put options. So what we're going to do is we are going to look at Tesla and look at calls, and going out to July 3rd, I would think that selling $350 would be pretty good, because if you have an average cost of $330, you're still making profits. So what we would do is we would sell $340 or maybe $350 covered calls. If we sell $350, these are $685 each. So now what we want to do is over the next 2 to 3 weeks, maybe June 20th, is we want to look at puts that can protect us. And put options around $600 are going to be around $280, $275, $277. So essentially by selling a $350, you can buy a $280, which hedges you on the downside. But granted, if your average price is $330 or $325, you're a little bit in the red. If you want to protect yourself for 2 weeks on Tesla and you have an average cost of $325, and let's say you just want to buy a $320 put, well, that's $2,700 because it's in the money. It's going to be very hard to do, as you can see. So you want to protect yourself from further downside. So what you'd be looking to do is buying a $290 put going out 2 weeks. It's $1,100. So in turn, you could go out to July 11th and sell a covered call, and you'd need to come up with $1,000 on a covered call. So what you would do is you'd be looking to sell roughly a $340. So if you end up selling a $340 covered call going out to July 11th, that would finance your put to June 20th. It would give you 2 weeks of protection. If your average cost is say $325, this is $15 above your average cost, which means you're getting out at a profit, and you have a $290 put, meaning you can't lose much more money than you already have. There's only $10 more of downside, so it protects you from an event of maybe the stock tanking further. If you sell this $340 for $1,080 to $1,100, and you in turn were to buy a put at say $300, well, then you'd end up spending a little bit of money. If we look at the $300, it's $1,500 roughly. So you end up spending like $400. So you can work it so that it's free, or maybe just costs a couple $100 to give you protection in this situation. I do it all the time. I go out further on the covered calls, and I'm able to utilize the covered calls to finance my put options. Now, if you haven't already gotten into Tesla, well, what we're looking at right now is we're going to delete this previous fib after I show you something. The most recent low and the most recent high, Tesla pulled back to 61 all the way down to the green at 50, and it attempted to pull back to 38, which is usually unlikely, and then it gapped back back up. And this gap on the 1 hour chart is going to usually be a support. So when we look at this, realistically, Tesla could drop a little bit more, but it's got a lot of support in here. So this 50% line on the fib is very strong. Therefore, 280 to 290 is the bottom right now. And that means that buying put options would be safe right now, but it's not really something, in my opinion, that I'm looking at that seems extremely risky. There is a lot of risk for sure in any stock, in any trade, but it seems that a lot of the damage has happened already, but there could be further damage, which is why I'm letting you know that buying put options, by selling covered calls and financing those puts, is a way to protect your investment. But if you haven't gotten into Tesla yet, then I'm waiting to see some stability and strength here, and you can buy Tesla at the current price or sell put options at 290 or 280, which is what I would do. I would sell put options in the 280 to 285 range. If the stock drops and you get assigned and then it starts to go back up, I'd immediately go up here and sell at 310 or at 320 and then buy a put at your entry. It's a caller strategy. And you can do this in tandem. You can do it completely in tandem. What I mean is, if the stock drops here and you get assigned, you now own the shares at 280 or 285 minus the put option that you sold. As soon as the stock starts going up away from 285 and it makes its way to 300 again, then you just go up to 325, sell a covered call, and then with that money, you could buy a 290 or a 285 put, meaning if the stock drops, you're covered completely, no losses. If the stock runs, you're capped at 320, which is still a great way to make money. This is the caller strategy. There's no way to lose in this situation, really, as long as you get into the stock and it goes up. If you get in and it goes up after you get in, whether it takes a day or a week, if you get in and the stock starts to go up and then you go above the price it currently is, sell that covered call and then buy the put at your entry, meaning if you entered at 285, the stock goes up, you sell a covered call and use that premium to buy a put at 285, then you can't lose any money because you have a put at 285 until that put expires. So if you do these options 2 to 3 weeks out, it gives you 2 to 3 weeks of caller strategy protection on your portfolio. And what I would do is I would sell some 285s and I would sell a couple of 270s, but it depends on your portfolio size. Remember, there's a lot of inherent risk when you're trading and investing, especially a stock like Tesla. So you don't want to be over leveraged. What you want to do is keep your portfolio to 10% in any one position or strategy or sector. And you want to be able to run my 33-10 rule, which is 3 trades out of 10, 3-3-3, giving you 3 separate trades, a dollar cost average, 2 on the dip, 1 on the high, and you can dollar cost average your put options as well. So if you want to learn some of these strategies, and whether you're new in the market or you're just losing money and you want to get better, I will see you at the webinar tonight, my free masterclass webinar, 6 p.m. tonight, Friday, June 6th, 6 p.m. Eastern, 3 p.m. Pacific. Links in the information box below. Very limited spots. A lot of students try to register and they miss out because they register too late. So you want to register now. This way you can get into the webinar tonight. I'll be hosting a Q&A, so I'll be able to answer your questions, hang out with you, and understand your goals and try to help guide you. And I also have a huge announcement. I'll be teaching these strategies. Look forward to seeing you at the webinar tonight. With Tesla, ultimately, there's a lot of volatility, and you have to understand that with volatility comes money. So Vega is directly calculating what percentage of volatility is valued at. So with this option $300 put going out to June 20th, you can see the Vega right here is 0.2355, and the volatility, the IV, is 68%. Every single percentage in volatility increase or decrease, the price will be affected by 23 cents a share, which, if we use our calculator, 0.23 times 100 means it's $23 on the put option. And this is per percent. So every percent in volatility is $23 on these options. And if Tesla goes up and down, volatility increases as the stock prices move up and down, is bigger or more swing during the day, especially at close of the day on Friday, or on earnings, it's even worse. There's more volatility. So if the volatility on Tesla was to increase 20%, you'd times 20 by 0.23 and you'd get $4.60 per share times 100. Each contract would go up $460. So if Tesla went up 20% volatility today and it just started swinging like crazy, these put options would have $460 more value. That's how Vega, and that is how implied volatility works, which is why the biggest way to make money in the market is the safe way. Selling put options on good stocks that are near a floor, utilizing good strategies, because if you sell a put option close to earnings at a stock that's somewhat near a bottom or somewhat near a support and you play it safe, well then as earnings happens, even if the stock stays the same price following day, the volatility volatility goes down because earnings is over and you get what we call IV crush, which means a stock will go from 120% volatility down to 50%. So if you imagine, let's say on earnings, just hypothetically, it'll be a lot more, but let's just say hypothetically on Tesla earnings, the volatility is 70%, and then it drops to 50%. 20 on this current situation times 0.23, again, we've done this before, is 46 times 100, it's 460, which means this $1,400 put option will drop by $460. It's worth $900, not even including theta, not including if the price goes up. So if the price goes up on earnings, it just destroys the option. But typically, Tesla is usually around like 90% on earnings, sometimes higher. So if we look at July 25th options, you will see that Tesla's volatility is about the same, but until we get to earnings, we won't know where the volatility goes. But sometimes it goes up to 80, 90%. So there could be a 30, sometimes even 40% drop. So let's say you sell a put option right now in Tesla for $300, for $3,000, volatility 67%. Well, as you get closer to earnings, after earnings, it's going to drop. So let's say you get a 40% drop. 40% times Vega on this situation is 44. That's 1760 times 100. Option will drop 1760 and it's worth 3,000. So if volatility crushes on a stock and the stock goes up, it's going to lose 60 to 70% of its value from the day of earnings to the day after, even if the stock stays the same price, because IV is going to crush it. So you have to understand volatility is not something to be scared of as long as you do your due diligence and protect your investments and trade the right way. If you want to learn more of these strategies, you guys can check me out on the webinar tonight, June 6th, Friday, June 6th, today, 6 p.m. Eastern Time, 3 p.m. Pacific. I'll be teaching a lot more of these strategies and showing you guys how to make more money in the market, to show you what you're doing wrong, how you're losing money, why you're losing money, and how to turn those losses into wins. I'll see you at the webinar tonight, guys. I look forward to seeing you on the next video. Take care, fam.